right. All right, people of the third dimension. Here we go. Here we go. Here we go. All right. So, welcome, welcome to the Blacksmith Podcast. Saturday morning Discord. You are listening to the soothing sounds. I'm just kidding. All right. Welcome, folks. I'm the Blacksmith Will B. This is the Forge. Welcome. You see that hammer hitting the TBP. That hammer's hitting today because we got some stuff that we need to forge. We got some knowledge that we're going to teach, and want everybody, gave everybody a second to get in here. Looks like we got who we got. All right, so I'm already recording this. So let's get started. So today we're going to be teaching on dividends. Oh, sorry. The Blacksmith Podcast on YouTube and every other platform you can think of. I took the domain name, but I'm only really active right now on YouTube. So if you go on the other stuff, Instagram, fan base, Facebook, all of that, you will see stuff, but not much. But I'm just an army of one right now. And so I'm still active duty, and I still do a lot. So I haven't hooked up all those other social media sites yet. However, they're coming soon to social media near you. Um, the Blacksmith Podcast. So it is a the vision of it is building a community of men. Usually talk to young men, guys who want to go somewhere in life but don't know how to get there. And I help guys see themselves for who they want to be 15 years down the road. Uh, Dress this guy down. Like, what does he earn? Does he have a degree? What hard skill does he have? Does he have a home? Does he have a family? And reverse engineer what he has back to their life to create. Well, you want to see what he has because you want to be motivated to be him. Then reverse engineer it back to themselves so they can make actionable steps to get there, right? And then step 4 is to take action and take the first step. And then step 5 would then be persistence. Persistence is key because you will have ups and downs, peaks and valleys. But when you are in those downs, you have to have the fortitude to keep going, right? You have to be persistent at going towards that goal, that dream. All right. So that's the vision of the channel, and I'm building a community of men who want to build something together, right? Guys typically don't have community where they can go and they can, vent, where they can go and they can um, be with some like-minded people who are trying to do the same thing, right? Just a hangout spot sometimes, but that's it. That's the Blacksmith Podcast, and we are growing, we are building, we are moving. All right, so we're gonna teach. I'm gonna teach today on investing in dividends. Now, what is a dividend? All right, let me make sure my screen is showing it. It is. Dividends are the percentage of a company's earnings that is paid to its shareholders as their share of the profits. So that's basically like saying if I earned $1 million and I shared 10% with you as a dividend, you will never find a dividend higher than that. Um, but you will, it's 10%. So you will find a percentage higher than that out there, but you will not find $100,000 dividend with just one share. But yeah, that's like saying I give you 10% of my earnings and I earned $1 million, you get $100,000. Basically, that's the concept. Um, so let's talk about. So there are all kinds of companies out there. I would that pay dividends. I would dare say most companies do not pay a dividend. Um, so let's go on Robinhood, and yeah, y'all can see what I'm looking at. I hate that the fact that when I click over here and do my thing, Discord goes black, so I have to always click back over to make sure it's showing the right screen. Anyway, so let me see. Let me show you a company that actually does pay a dividend. Good God Almighty. All right, so Coca Cola. All right. Coca Cola, it tells you all this information, who the CEO is, how many employees, where they're headquartered, when they were founded. Good to go. Now you scroll down here to their market cap. That's a huge market cap. Their high, 52-week high, low, 52-week low, 52 weeks in a year, right? That's why 52 weeks. Price to earnings ratio, we can talk about that too. And then here is what you're looking for. Their dividend yield is 0.31%. What does that mean? So right now, their stock is trading at about, let's say, 1292. 1292. I'm using my calculator. Y'all can't see this screen. 12. Oh, maybe I should get that calculator. Hold on. Let me open another screen because let me see my calculator, because why would I not want y'all to see the screen, right? I just need the regular calculator, basic calculator. Okay. I don't know if y'all can see this one either. Hold on. Nope, you can't see it. Doggone it. Just give me the regular calculator, man. Oh, these computers listening to you, boy. I tell you. Okay, y'all should be able to see this one. Yes, you can. Okay, now, so 1292, if you do times 0.03, actually, it's 0.31%, right? Yeah, so you'd have to do point, I can't delete. Okay, 1292 times 0.0031 equals $4, basically. So what does that 0.031 mean? Dividend yield, that means you first have to figure out what that amount is. That is the amount of money that that stock is going to return you every year from having just one share. So basically 0.31% of 1292 is $4. So $4, that's 12 months, right? So if you divide this by 12, you're going to get 33.3 cent per month from this stock. And most stocks pay their dividends out quarterly. So when you get paid a dividend, you'll probably get about $1 every quarter, which would then equal $4, right? That's how dividends work. All right, chat. I see y'all in here. If you got any questions, go ahead and throw them in there. I will try to answer those live. Today, I'm trying to hold to 1 hour. All right. So we got about 45 minutes to go. All right. So most companies are going to pay out their dividend quarterly whenever they do their what do you call them? When they run their numbers, they do their calls, their quarterly earnings calls. There we go. So if you look right, I'm pointing. Y'all can see it with the mouse. Here we go. I'm still new to this. All right, so as you can see, their quarterly earnings, they'll have what they expected and what they actually did. It looks like they hit all of their estimated ones because you can't see this one right here. If you can see this one and it's above, then that means they actually were below what they were projected. If it was below, that means they were above what they projected. But that is part of what helps them figure out what percentage of dividend to eke out. And I would say 0.31% on a dividend is pretty darn common. Most most companies do not pay a dividend. So if you can find one that does, that'd be great. Let me see Pepsi. I don't know if they do. All right, so now look, Pepsi's trading at $149.30, and its dividend yield is 3.57%. Now, I'm going to tell you something. The higher you see a stock go, the lower percentage a dividend they're going to pay out. Just imagine if they paid everybody out 3% of $1,200. That's a lot of money they're going to be losing. So you don't want your company paying you that amount of money. You would think, yes, I do. No, you don't. And I'll tell you why. Because if they're paying you that amount of money, how much profit are they actually taking in? They need the profit to put back into the company to make that stock price go even higher, right? Um, so they can keep earning. So if they paid you out that amount of money and they went bankrupt in 5 years, you got 5 years worth of high dividends when you could have gotten 50 years worth of low dividends and far surpassed those 5 years. Got to think. Use that cabeza. All right. So now Pepsi. Pepsi pays 3.57%, and they're trading at 149.3. 149.3. So let's go 149.3. We're going to multiply this times 0.0357. All right. So um, Pepsi pays $5.33 per year for one share. Now, if I ask you which is the better buy, I think you would get this one correct. Chat would tell them which one's the better buy. We got Pepsi and we got Coke. Pepsi is almost a tenth of the price of Coke. So let's just go ahead and say Pepsi's the better buy. You're only spending about $150 per share. You can almost get 10 shares of Pepsi from what you would get one from Coke. Coke pays, what was it, $3 and it was $4, $4 even. Let me put this in the chat. Coke at, what was it, 0.31% of a dividend yield equals $4 a year. All right. So remember, most companies pay quarterly with their dividends whenever they do their earnings calls, right? So that's $1 every 3 months, right, per quarter. Now Pepsi at 149. Oh wait, no, I didn't put the stock price. I should have put the stock price, but at 3.57%. Is going to equal, was it $5.33 a year? All right. So Pepsi obviously is the better buy because if you break that down, let's see if we can do the math. Let's see if I'm better at math today than I usually am. So Coke's price divided by Pepsi's price. I figured eight 0.67 shares, right? So with the same amount of money that you could buy one Coke share that's going to return you $4 a year, you could buy 8.67 of Pepsi. Now watch how this works. So you take those 8 shares and you multiply it by the $33. Now, Pepsi, with the same amount of money, is going to return you $46.21 a year. Now, if you divide that by 12, it's going to pay you $3.85 every quarter, right? So Pepsi is the clear winner when you talk about dividends, right? But if you're just looking at it on its face, the dividend yield simply tells you from what a stock is currently trading at, how much of that share, what percentage of that share cost the stock is going to return to you every year. It's only on a 12-month basis. And if you ever wanted to check the dividend yield and make sure it is up to date, just go to NASDAQ. So, excuse me. I think I burped into the mic a little bit. No AI over here, folks. I'm real. NASDAQ. Let's go Pepsi. All right. So, hold on. There we go. PepsiCo dividend. So 3.63%. Now, what does Robinhood say? All right, it says 3.57, which tells me that this dividend, quarterly dividend amount, $1.35. This dividend, I got to see, when is it updated as of, it usually says right here. Yeah, it has January 24th right here. So this dividend, they might have, I don't know if they did their earnings call yet, but if they haven't done their earnings call, or maybe they just did, maybe the dividend just went up. And Robinhood usually takes, within a week, they usually correct their earnings, their dividends. All right, any questions from the chat? Just keep going, okay? All right. So that's a regular stock. Let me show you a couple more because I know Microsoft has one. Let's go Microsoft. I know they have a dividend. Now, again, look, Microsoft is trading at 148.97. No, it ain't. I knew that was wrong. 443.26. That would have been a dream. All right. Microsoft is trading at 443.26, right? Now, look, the dividend yield is less than 1%, just like Coca-Cola. So how do we find the dividend yield? Now, remember, this is telling you what percent of this $443.26, if I purchase one right now, that would be what it cost me. What of that is going to return you within 12 months, 1 year, right? So we'll take 443.26. And we'll multiply it times 0.0069. That's $3.05 a year, right? Now you have to divide that by 12 and you get 25 cents per month. I'm sorry, per month. And then if you multiply that times 3, because it's 3 months that equal a quarter, you're going to end up with 76 cents per quarter, which is going to equal that $3 that you just saw, right? So Microsoft is going to be a worse buy, I guess, than Coke. No, it'd be a better buy because Coke is worth almost 3 times what Microsoft is. So that $3 would actually be about $8 or almost $9. So they'd be a better buy. All right. So let's look at another one. What's another one that has a dividend? NVIDIA. Let's go with NVIDIA. Let's get it. All right, NVIDIA. Let's see. Is it really 142 before I go running my mouth? Yeah, 142.02. Nvidia is trading at 142.02. Now, it pays a dividend yield of 0.02. All right. So let's figure out what that is. I forgot the number already. Oh, it's at the top of the screen. See that? Look, that's a beautiful thing. Y'all see my mouse? Bam. I don't even have to go back to the screen. All right. So 142.02. And my calculator's not typing. 142.02. And we want to multiply it by, now see, I was celebrating. Now I got to go back. I think it was 0.03, 0.02. All right. Times 0.02 would be 0.0002 equals. All right. So 2 cents a year. Did I put too many zeros? It's 0.02. So it'd be I think I did it right. I'm pretty sure I did it right. Let me do this again. 142.02. And it's 0.2 or 0.02? No, it'd be 3 zeros. 142.02 times 0.123. Oh yeah, 2 cents. 2 cents a year. So we ain't even got to break this one down. Just and see, folks, this is exactly why when you talk stock market, right? The stock market has always been a rich man's game. It's been a middle class man's way of earning over time his way into putting his children in the next generation on that top tier when they start out, right? Because they're building generational wealth. And so you have to get a good career because a lot of careers way back used to pay a lot of stock options. Careers nowadays still do, jobs don't typically, right? So you have to get into management in some of these corporations. And sometimes it's not about all about the salary or the hourly wage. Do they come with stock options? Because part of your actual salary, they will pay you in stock options. And you want that because if you are not disciplined enough to invest on your own, get a career where they're going to invest part of it for you. They pay you part of your salary and stock options, and then you can still have a 401k, 403b, TSP, IRA, right? You can still do that, and now you're investing twice. You have a retirement fund, an individual retirement account, right? And then you have stock. All right. Now, we've seen some of the biggest companies right now that pay a dividend. And the dividend is very incrementally small, right? Does everybody in the chat understand how dividends work? If you do not, ask questions now, or I'm going to keep going and you'll be lost in the sauce. You don't want to do that because if you are still hung up way back here, when I get over here, you won't be able to follow because you don't understand, right? So ask your questions now. All right, I'm going to keep going. So you see, oh, somebody's typing. I'll stall a little bit. Okay, so you see some of the biggest companies that pay a dividend. You still need to know more info. You're still new at this. What is it that you don't understand? You got to be more specific. Tell me top to bottom, like you. So, okay. So let's go back to the stock. So here's Nvidia's trading price, the current trading price, 142.02. So if you wanted to buy one share of this today, it will cost you $142.02. Nvidia has a dividend yield of 0.02%. The company sets their dividend yield. They decide how much money they're going to return to the investors because they still have employees to pay. And the employee is actually the most costly part of a company because it's not just their salaries. If they're going to offer a stock package, it's the stock options. They have to pay for the benefits package for all of the employees so they can um, they go to a health company and they charge them a certain amount per year for a benefits package. So if the employees want it, now they have to pay for that too, the health insurance and stuff like that. There's also if the person gets laid off, now you got to pay for what do you call that? Unemployment for the person, right? And there's more because you also have on their salaries, there's a 15.3% payroll tax on every employee's salary, right? So the employee is the most expensive part of a business. So when you see some of these companies and they got 29,000 employees or they got 700, you're like, oh, that's not a lot. That's a huge corporation. Yeah, because they want to keep most of their earnings, right? All right, so Jensen Huang, this guy is awesome. If you don't know who this is, Jensen is an awesome CEO. You got to follow the CEOs. Okay, so the stock is currently, I done digressed on a squirrel. Okay, so NVIDIA is trading at 142.02. We already covered that's the amount of money it will cost you to buy one share. The 0.02% indicates how much money of the $142.02 that they are going to return to you in 1 year, in 12 months. So they pay dividends. Remember, let's go back to the definition. A dividend is the percentage of a company's earnings that is paid to its shareholders as their share of its profits. So in a year, if I earned $1 million and my dividend Will B's or the blacksmith's dividend is 10% and I earned $1 million, I'm paying you as a shareholder for one share $100,000. Does that make sense? All right. So okay. So now we've seen big companies that have been around for a long time. I mean, Nvidia has been around since '93, and I'm older than that, so I'd say that's a long time. No old jokes. All right. Um, we've seen those in the incremental dividend they pay. This is why when I'm teaching dividends, I always tell people to start off with a larger dividend. And the way you do that is by investing into REITs. If you don't know what REITs are, I will tell you really quickly. A REIT is a real estate investment trust. REITs are an excellent way to get started investing in the stock market. Hold on. All right. So REITs are an excellent way to get started investing in real estate through the stock market without having to have the money to pay 100 grand, $2 million for real estate. Let's define it up. All right, what are REITs? Real estate investment, or yeah, real estate investment trust allow individuals to invest in large scale income producing real estate. A REIT is a company that owns and typically operates income producing real estate or related assets. What does all of that mean? They figure out what real estate they want to invest in, and that could be apartment buildings, that could be storefront, like if they have a plaza and they have a bunch of storefronts in there and they own the land and they collect rents off of each of the businesses. It could be anything. It could be skyscrapers, any kind of real estate that's producing income. And the reason I want you to start investing with REITs, not because they give me a kickback. I wish they gave me a dividend of that and then me buying the stock, but they don't. Not yet. Not yet. The blacksmith. Fortune. All right. So the reason I want you to start with REITs is because REITs pay a very high dividend. How can they afford to pay such a high dividend? Well, I will tell you. Let me see. I could tell you or I could show you, and I'd rather show you. REITs do not, they're able to avoid a lot of taxes on their earnings because they agree to pay about 90% of their earnings to their shareholders. Oh, here we go. Special tax considerations. Look, I got it. Got it for you. It won't fail you. Don't let me fail you. Most REITs pay out at least 100% of their taxable income to their shareholders. The shareholders of a REIT are responsible for paying taxes on the dividends and any capital gains they receive in connections with their investment in the REIT. Dividends are paid by REITs dividends paid by REITs generally are treated as ordinary income and are not entitled to the reduced tax rates on other types of corporate dividends. Consider consulting your tax advisor before investing in REITs. I'm going to tell you right now, I don't pay dividends on my REITs because I'm going to show you why right now, but I can I can tell you better. No, I can tell you for no, just shh. Blacksmith, just bring it down. All right. I don't pay dividends on my REITs because I don't extract the dividends. I let the dividends reinvest. So let's go to account over here. I use Robinhood. First of all, Robinhood is very user friendly. I'm going to tell you something. Like, if you want one that is easy to start with, it gives you a free stock as soon as you create a an account and is very user friendly. Get Robinhood. They don't pay me either yet. I tried to sign up for your affiliate marketing program and you said no. I'm not big enough yet. That's really what it is. Don't cry for me, Argentina. Let me see. Okay, I'm doing this wrong. Hold on. All right, I didn't want to steal my thunder, but I'm going to go into one of the REITs that I invest the heaviest in to actually, because I'm trying to find, there is something I'm looking for. And I keep forgetting. Here we go. This is why I don't pay taxes on my dividends because I have something turned on in my account called Drill and the Drill Drip. Okay, so dividend reinvestment program. So I have that turned on. Where is it? 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 It's in here somewhere. Anyway, I have Drip turned on and I'm on the PC and I always have problems finding it on the PC. It's really easy on the phone because there it is. Oh Jesus. Mary and Joseph is right in front of me. Right here, dividend reinvestment. So I don't do this enough. And when I get more reps, I'm gonna get buff at this too. All right, so look, you can pick for all these stocks that you have, even if they don't currently pay a dividend, you can turn on drip because let's say a company decides, yes, we're going to start paying a dividend now. When they do their earnings call, if you don't have drip turned on, what's going to happen is drip, the money is going to go here into your buying power versus going in back into the stock. And what do I mean? I mean this. So with drip turned on, okay, you can see right here there's a dividend of $78.28 pending for 2 days from now. So on Monday. So this is going to hit my account. Now, dividend, so they announced it. It was confirmed on January 2nd. Now, on the 27th is when they're going to pay it, right? So, what does this tell you right here? I'm getting ahead of myself. Doggone it. But I started it now. Now I have to finish it. They announce what dividend you're going to get based off of how many shares you have of this stock on the first or the second, basically. The second is what it says. So could you play a game with it and buy 100 and let it confirm and give you a $8 pending dividend and then sell it afterwards? Yes, you could do that. I did that by mistake, and that's how I found out. I did it with a different stock. I'm gonna show you all about it. But let me not get ahead of myself because I don't want to run a speed everybody can't keep up with. So they decided they're going to pay the dividend on the 27th. And then because I have the dividend reinvestment program on, it takes 78.28 and it's going to look at the share price when it pays out. So let's say it was today, it's going to look at $6.62 and it's going to buy me, let me see, what was it, 78.28 and then divided by 662. Yeah. So it's going to then buy me 11 more shares, 11.82 shares. And that's going to now add to this. So instead of having 978.551, 978.551, I'll have 990 shares, point all of that, decimal. All right. So what does that mean? That means that 11 point, what was it, 11.8? Oh, here's another thing. This one pays 8 cents per share, right? It straight up tells you that, right? So then you take 11.8 times 0.08. It's going to pay me 94 cents, 94.4 cents. All right. Now, I'm not done with REITs. The reason why I want you to invest in REITs is because they pay usually 90%. This says 100. They usually pay at least 90% to avoid the all those taxes. They usually pay about 90% of their earnings to the shareholders. Another reason why I want you to invest in REITs is because their dividend yield is pretty high. Why? Because the stock price is pretty low. Dividends, there's a couple of different types of stocks, but let's deal with two, right? There's an equity stock like Microsoft, Nvidia, Amazon. Those you buy for the equity. You buy them today for $80 so that in 2 years they're at $150 and now you have $70 worth of equity in the stock. If you sold it, you would get $150, but you have only earned $70 because you bought it with $80. Does that make sense? That's equity, right? REITs may be $6 today, and they 2 years from now might be $6.30. They stay pretty even where they are. Maybe they went up to $7 in 2 years, or in 5 years, they're $8. There's not much equity in these stocks. So over time, they're not going to move up and down that much. However, there's a huge, huge dividend they pay out. So you have to look at, you're not buying it for the equity, you're buying it for the dividends. So you could, and I like having my portfolio split to where I have a good measure of dividend stocks and equity stocks, right? Equity stocks are obviously going to bring you home the bacon. That's how you're going to make most of your money in your portfolio. However, the great, not yet late Warren Buffett said that if you do not find a way to make money while you sleep, you will work until you die. And if you don't want to work until you die, then you need to make passive income. That is the only way that you're going to be able to stop trading time for money, right? So, in order to stop trading time for money, you need money to come in passively. And so, you need to make money while you sleep. Dividends are a really good way to make money while you sleep because they're going to pay. Once you buy the stock, it will continuously produce dividends on a quarterly basis if you buy a regular stock, or with REITs on a monthly basis. That is the other reason I wanted you to invest in REITs. So you get a high dividend because 90 to 100% of the earnings are paid out. Um, let's just go to it. Let's show you. Earn is 6.62. $6.62. That is right. That is what I said. Now, I will let you know, and I'm going to show you too. I bought Earn the first couple shares, maybe 10 of them, in 2021, right? Summer of 2021, I believe. So I've had it for 3.5, almost 4 years. And look, the equity I have in it is only 3.5%. You could have done better putting your money into a saving CD that gets 5% return, right? However, let me show you something. Don't jump out the window on me yet. I'm going to show you the history so you know I'm not fibbing. I'm not telling a tall tale. Got to go all the way down. Look, first 10 shares, September 9th of 2021. So a little over 3 years ago. All right. And it was $11.34. So it actually came down over time, right? Which sounds like a bad thing, but it's actually a great thing. So how did I earn 3% if I bought them this high? It's called dollar cost averaging. So you might have bought it high at its peak, but as it comes down, you continuously buy it so that you bring the average price that you bought it down with it. Because look, there's 10 more shares next month. And then look, I turned on drip right away. So from the September shares that I bought, the dividend was higher. It was 30 cents. You can tell because 10 times 30 cents would equal $3, right? So my first dividend I ever got from this stock was $3. Now in October, I own 20 shares. So, or did I sell them? I'm trying to follow this. So that's 20 shares. That's 30 shares. I think the dividend right here had fallen down. But look, you can trace this all the way back. Look at these dividends. $2. Yeah, the dividend was falling right here. So $2 invested, right? So the dividend percentage was falling. So now look, September of 22, I have 30 shares at $6. I bought that. I'm sorry. Where's the dividend? Now I'm up to $5.50. All the way, all the way, all the way, all the way, all the way. Where are we at? $24? Nope. Here we go. $24.85, right? Keep going, keep going. Okay, let's just go to what it is today. All right, 78.28 pending, right? Now let's go back to earn. Why do I have 78.28? I need to pay for high-speed internet. I'm just playing. I love y'all. Okay. This stock right here, pays a dividend yield of 14.5%. Remember, I showed you Coca-Cola that paid a dividend yield of, I think, 0.31. Pepsi paid a dividend yield of 3.57%. Microsoft paid a dividend yield of 0.69%. Look at the REITs, the real estate investment trust, 14.5% on its dividend yield. Now, this will fluctuate from quarter to quarter when they do their earnings call. But again, this is the power of investing in REITs. So you can invest in Microsoft, which is returning you 0.31 of $1,292 for one share a year, which ended up being what, $3? $4. Oh no, it was Coke. Right? But watch this one. So this one out of $6.62 is going to return you 14.5%. So let's do this math real quick. 6.62 times, that would be 0.145. So that's going to return you 95 cent a year. So now what you want to do is you want to divide this up by 12. That's almost 8 cents per month, right? And now let's see it. Let's see. I already know the answer to this, but where did I find it? Right here. See, 8 cents per share. It's telling you it pays 8 cents. It's so close, it just goes ahead and pays you 8 cents per share. So now this one pays you 8 cents per year, right? That's way lower than all the other ones, right? But if you had, what was it to buy Coke? $12.92 per share. So if you had $1,292 divided by $6.62 per share, you'd have 195 shares of earn, right? Now, if you do 195 shares times 0.08 cent, you'd be earning you'd be earning 1561 a year. Now, if you divide that up by 12 months, you're earning $1.30 every month. And remember, most stocks pay quarterly, REITs pay monthly. So this is what you're earning every month in dividends. Now, I'm going to tell you right now, I showed my wife the first little $3 dividend. I say little. I had the grand scheme of earning a lot of money per quarter, but she laughed at it. She kind of snickered. She giggled. And she ain't giggling anymore. Now the $78 a month is coming in from one stock. See, now that it's 78, it's not funny anymore. So this is how you do it. Stock was always a rich man's game because it's about volume. It's not about buying one share at $1,200 and hoping and praying and crossing fingers. No, it's a volume game. So this is why I'm getting $78. They're taking the amount of shares I had on January 2nd and they're multiplying it by what they pay per share and they're divvying out the dividend. All right. So let's look at another one. Chat, let me know something. Are y'all getting this? Or do y'all need more clarification on how dividends work? Let me know something. All right. Let's look at another one. So Earn is a good one I tell people to start with because it's nice and cheap. It's easy to understand. It pays a super high dividend of 14.5%. Now let's look at Orchid. I always say Oracle. Orchid Island Capital. All right. So this is trading at $7.97. Now, if you look right here, again, it's not an equity stock. It didn't go way up or way down. I've actually lost $52 overall on this stock when in terms of equity because I bought 573 shares at an average cost of $8.06, and it's trading beneath that. It's trading 9 cents beneath that. So I lost 9 cents on all of those shares. I'm down $52. Don't care. I'm going to show you why. Remember, you have equity stocks that you buy for the increase in value of the share, and you buy dividend stocks for the dividends is going to kick you out. And I stick to REITs because they pay monthly. All right. Now look, I got ahead of myself. Okay. Now look at the dividend return percentage, the dividend yield. 18.16%. So if you did simple math, you can tell which one is going to return you more money per year, Earn or Orchid. I'm going to tell you it's going to be Orchid. Why? Because Earn is trading at 662 and it only pays 14.5%. This one's trading at about $8 and it's returning you 18%. So the simple math of it is, if you wanted to know which one is the better buy, it tells you right here, $8, we're going to return you 18% of $8 or 14.5% of $7. No brainer, easy math. But let's see what that does. Well, let's not even get out the calculator. But, well, I'll show you how to calculate it. Yeah, let's do that. I'll show you one more time. So $7.70 per share for Orchid Island Capital, right? Right here. And then you multiply that by this one was 18 something, right? 18.16. So you will go 0.1816 equals $1.44 a year. So it's going to return from about $8, $1.44 a year. Now, simple math, if you divide that by 12, that's 12 cents a month, right? Now remember, we don't have to do a quarter. It'd be 36 cents per quarter, but remember, REITs pay monthly. So you're going to get 12 cents on every share of Orchid Island Capital you have per month. So you want to do some easy math? If you had 100 shares of ORC, next month you would get $12 in dividends. You want me to show you? It's not a scam. It's what rich people have known for eons, and we are just now catching on to. I will show you. Here's the history of me buying it. Now, this one, I only found this one last year. Only in 12 months or 11 months have I had this stock. So I found it last year, trading at 847, because I was just looking, I was playing with dividend yields, right? And I just searched dividends, and it showed me dividend yields, the highest percentages. You can Google it, right? And not all of them are going to be available on Robinhood, but that's where my portfolio is. I could have Charles Schwab, I could have TD Ameritrade, I could have all these other ones, but this one is the most user-friendly one that I've used, right? So look, my first 100 shares came a year ago, or February 22nd, so 11 months ago, had 100 shares at 847. Now, you do have to sacrifice. I'm going to tell you something. Could you use 847 in your dollars in your everyday life? Of course you could, right? But this is the Blacksmith Podcast, and we are forging. Oh, I knocked my light down last time. Hold on. We're forging today, and I'm going to teach you something, right? If you take this $847 and pay bills with it, then you'll always be paying bills, right? You have to have, maybe you pay minimum payments or a little more than that, and you crawl your way out of debt. Stop buying liabilities with your money, buy assets. So I can go to any person's, usually 80% of the time, this will work every time, Anchorman. So it was 60% of the time. Anyway, I can go to your driveway or the parking lot with your parking space. I can see what's parked there, and then I can walk in your place and look in your closet in your living room and tell what you spend your money on. And most of the time, what I'm going to find in your closet, living room, and driveway are liabilities, not assets. So that's a chunk of change to spend. But now look, the very next month, there's the $12. See what I'm saying? So it's been paying 12 cents per share per month since at least February last year. Now you want to see? Look, look, here's drip, right? You said that's the long game in the chat, and you're exactly right. So from that $12 from the 100 shares, it bought me another 1.365187 shares at the price it was trading at, right? So now, I didn't buy any more for a while. So now, because where are we at? Now I have 101.36, all of this shares at 12 cents. It bought me now 1.4 shares. See that? So it went up from 1.3 to 1.4. This is me putting no extra money in it. This is compound interest too, undefeated. Now, I showed y'all last week or the past 2 weeks how an IRA is undefeated because of compound interest. Let me show you how it works with dividends and stocks if you have dividend reinvest on. If you are taking the dividends, it's paying me $5 a month, and you just pulling the $5 out, you're an idiot or super poor and needy. And I could just let you have $5. Anyway, so now it's reinvesting and it's buying more. Look, 1.44, now it's 1.48, now it's 1.55. And I didn't catch on until much later in the year. Now look what I did. September, all the way to September. Now I bought 27 more shares, right? Then I started a recurring buy. I started buying every month, having it pull out of my account every month. Actually, this one was a weekly one. I had it pull $7 out of my account every week, and this is something y'all can do. Here's some game I'm giving you. Every week, have it pull a small amount out of your account that's junctioned to your portfolio. $5 every week. Do you know what $5 every week is? It's negligible, right? $10 every week is $520. There's 52 weeks in a year. Let's do the simple math. Just add a zero to the end. If you cut that in half, that's $260 a year. So if you let it pull $5 every week, you're going to invest $260 a year into ORC. Now, let's do some simple math, right? $260 divided by 797, because that's what it's trading at. You'd have 32 shares at the end of 52 weeks, right? And if you multiply that times 0.12, you would start getting paid at the end of that 52 weeks. You would have a total of $3.91 paid out to you every year. That would be what your annual dividend is. Now, if you divide that up by 12, you'd be getting, oh, I'm sorry. Whoa. Let me do that all over again. 260 divided by 797. I think I messed up. Yeah. So it would buy you 32 shares. That's what it would be. At the end of 52 weeks, you would have 32 shares. Now you multiply that by 0.12. Yeah. Okay. So I was right. All right. So you would have $3.91, and that's going to pay you. That's what you're going to get paid for having that every month. All right. But now it's not going to start there. You're going to buy, if you do $5 per week, every month it's buying you $20. So you're going to get roughly almost 3 shares every month. So you're going to earn in the first month 24 cents, right? So let's show you how this shakes out and how it compounds. So you'll have $20. No, you wouldn't do that, because 4 weeks in a month usually, right? So you divide it by 797, and that's going to buy you 2.5 shares. I keep looking over here. I got 2 screens, folks. Bear with me. The camera's here. I guess it's bothering me more than it's bothering y'all. So it's going to buy you 2.5 shares in the first month you do this, right? So now you take that and multiply that times 12 cents. And in the first month, your dividend is going to be 30 cents, right? So now you take and you add on. So remember, 30 cents is your dividend for the first month. So now you take another $20. I don't know why I'm using the mouse. It's way slower. You get another 2.5 shares, right? You multiply that by 12 cents. You get another 30 cents. Now you add that to the 30 cents you already had. Now you're getting 60 cents in dividends the second month. See how this can add up? In the fourth month, in the third month, you're going to get 90 cents. In the fourth month, you're going to get $1.20. And that $1.20 is going to keep going. If you stop adding money right there, the $1.20 is going to keep rolling over, right? But you don't want to stop there. Play the long game, like the chat just said. So that's Orchid Island Capital, right? So now let's see what my dividend is for this one. $67.35. Y'all can still see what I'm looking at, right? Yeah. Okay. Cool. All right. So $67.35. Why? Because I have 561 shares at 12 cents, and it's gonna, if you multiply it, that's what it adds up to. So now when DRIP turns on, let's say, what is it, 67.35? So now when it pays me out that money, 60, I keep forgetting, 67, 35 divided by $7.97 equals 8.45. So that's how many more shares I'm going to get, right? And then if you multiply that by 12 cents, that's going to give me another $1.01 to add on. So then my February dividend will be $68.36. See that? That's the long game. That is the long game, chat. So I hear you, I see you, and I dropped I kept the weekly, buy. See that? So now what is happening right now? I'm doubly compounding my dividends. And I want you guys to really do this, right? I want you guys at your level. There are investments you can make at your level right now to play the long game. Stop all the get rich quick schemes. Stop all the dreaming of driving a Hellcat next week. It ain't going to happen. It's just not going to happen. Most people can't afford a Hellcat. And let's be real, the Hellcat was not invented. It was not manufactured for the average man. The average man earns about $50,000 a year in America, 50 something thousand dollars a year in America. So the average man can't afford a Hellcat. Get your mind off of Hellcatting, or maybe place it in your future goals and start investing so that you can earn it one day. See what I did? Earn, but blacksmith and the corny jokes. All right, so look, let's keep moving. So I want you to be able to invest at your level and be able to win at your level. This is a win. If you can't afford $8 to invest in the stock market right now, we need to sit down right now. We need to have open purse surgery, or open wallet, not heart, but open wallet surgery right now. Because something's wrong. Something's extremely wrong. And so what else was I going to say about this one? So I'm doubly, I know what I was about to say. I'm double compounding my dividends. How? Well, first of all, I'm buying shares that pay a dividend. So that's number one. They pay a dividend monthly. I think that's still part of number one. But because they pay dividends and I have dividend reinvestment on, it creates a machine, an engine, right? That once you turn it on, the gas you used was the first money used to purchase it. So $7.97, right? That's the gas. And now you turn the key when you hit buy, and it turns that engine on. So every month it's going to kick you out 12 cents. Well, if you keep reinvesting that 12 cents, remember by the end of the year, it's going to pay you $1.44, because 12 cents per month, every month is 12, or there's 12 months. So $1.44. So now those dividends incrementally keep investing by themselves perpetually. If you don't know what perpetually is, it means forever, right? And the only way that dividend will stop is if they take away the dividend. The only way it will reduce is if they reduce it from 12 cents per share to 11 cents or 10 cents. But sometimes they can actually increase it to 14 or 16%. You just got to pay attention, right? So, and then so the double compounding, I already created a self-sustaining but self-increasing engine as well. It is actually buying me more shares as time goes on, all on its own, if I put no more money into it. But I'm compounding it because over time, I'm putting more into it. I'm putting $7 a week into it. Now let's do some math. 7 times 52 equals $364 a year that I'm putting into it slowly over time, right? If I divide that by $7.97, that's 45 shares a year I'm also buying and putting into it. Now, if we multiply that by 12 cents per share. That's another $5.48 every year I'm putting in dividends as compounding onto the $1.44. Y'all get that? Y'all see that? I am doing double compounding, right? Compound interest is undefeated, folks. It is undefeated. And you have to plan this. This isn't Publishers Clearinghouse. They're not just going to come to your house with a check. You have to take your check, and when you cash that check, understand it is not open season on 100% of that money. It's just not. It's not open season on all of that money. If you think all of that money is for you to spend every single month, then forget about investing. You don't have the long game mindset. This isn't for you. Get out the forge, because this isn't for you. This ain't entertainment. The forge is hot, but you can't stand that heat. All right, let's look at another one. If you have any questions, if you're lost, ask now while I'm live, because once this forge closes up, it's going cold for another week. Well, the chat will be open, but I'm not going to be on live for another week. All right, now let's look at another one. Where's my other REIT? There we go. I invest in 3 REITs currently, right? Now this one. This is a heavy hitter right here. This is Armour Residential REIT. Now you see, EARN was trading at $6.62. Orchid Island Capital was trading at $7.97. Armour Residential REIT is trading at $18.58. So you would think, well, why wouldn't you just buy the cheaper ones? Well, there's a couple of reasons for that. Save that question, right? And look, I lost money on this one too because I bought it at an average of 19.57. This is a dividend stock. It is not an equity stock. But even with equity stocks, you can make a bad move and buy it too high, right? I'm not worried about the 5% loss I almost wanted to say made. I'm not worried about the 5% loss, the $400, and I'm going to show you why. Over time, this stock is going to go back up, and I'll even buy it if it goes to $17. See, I have alerts set on these. So if it goes to $18, if I buy 50 more, it'll dollar cost average me down, right? So my average cost will come down, right? And it depends on how many shares you buy. So if I bought 200 shares, it'll come way down from $19. If I bought 1,000 shares, it's going to come way down closer to $18 as if I bought 10, right? Then if I bought 10. All right, so now this one pays 15.56%. So it actually pays a higher percentage than EARN does. If you remember, EARN was 14.5%. Orchid Island Capital was 18.13, and this one is 15.56%. Let's do some math. Now remember, 15% of that number, 1858, is what it's going to return you. Get rid of this mortgage calculator. All right. So 18.58 times 0.155 is $2.87, not seven, a year. Now that's pretty close to $2.88. I guarantee you they're paying $2.88 a month. But let's look this up. Where is my NASDAQ? ARR, dividend yield. 72-cent quarterly, which if you divide that by 3 is 24 cents. So yeah, it should tell you though. Here it is, $2.88 right there, 288 right here, and it tells you. This is what I was looking for the other one, but it tells you on the January 15th that they verified that the dividend yield is 15.58% and it's paying $2.88. Now see right here, this hasn't caught up to the 0.02. So it's supposed to be 15.58. All right. But for all intents and purposes, it's paying $2.88 per year. Now, if you divide that up by 12, 23.99, it's 24 cents per month, folks, per share, right? So for every $18.50 you spend on this, it's going to pay you 24 cents. So let's look at the dividends upcoming. So there's $92. And again, REITs, most of them pay monthly. Thank you for joining us, good sir. So most of these pay monthly. So now look, on January 16th, they confirmed how many shares I had, and I had this many. And on the 30th, they're going to pay out this much, and then they're going to reinvest the dividends. So what they're going to do is take the price of the stock on whatever day, on this day, the 30th, let's say it ends up being 1858. They're going to take 358 shares and they're going to pay out 24 cents per share. And they're just going to reinvest this $92. So what I mean is, whatever the share price is on the day they reinvest it is how many new shares I'm going to get. So what is it? 92.48 and it's 18.58. 92.48, 18.58. It's going to buy me an extra $4.97. Okay. And if you multiply that by 24 cents per share, that's going to pay me another $1.19 in dividends per month. Anybody confused? Do you all get it? Are we all on the same page? Do we see how dividends work? Do we now know what a dividend is? Do we now know some companies that pay dividends? Do we now know the difference between an equity stock and a dividend stock and why you should have both? Do we now see the value in dividends? Do we now understand REITs? Because I taught you a couple lessons here. Real estate investment trusts, right? Do we understand those and how different they are than an equity stock that pays dividends? What the difference in that and a REIT is? Are y'all getting these? Do you understand how dividends compound over time if you have the DRIP turned on, dividend reinvestment program, if that's turned on? And do you understand how you can double compound your dividends? If anybody's confused, put it in the chat now, because if we understand this, we can go ahead and close this bad boy out. Okay, so Armor, again, I got $7 a week going into this. So every 3 weeks is buying me another share. All right. So easy enough. That's like 21 shares a year, right? I said easy, but I'm going to do the calculator. I don't care. 17? All right, 17. Whatever. All right, what we got? 92 and 18. I thought the answer would be 4.97 shares. Oh yeah. You're correct. You are correct. I did that wrong. So the $92 a month is divided by the cost of the stock, the $18.58. I was going too fast. I was smelling myself. It is 4.97 shares if I didn't say that. And in that 4.97 shares, maybe I misspoke. I thought I did it right. The 4.97 shares multiplied by 24 cents is $1.19 a month. Yeah. So if I didn't say that, that's what I meant. That is correct. All right. So I'm not concerned with the negative 382 that I lost in equity on this, and I'm going to show you why. I didn't buy it for the equity gain. I'll get that back over time. But let's look at ARR. So the first 50 shares, I bought this a year ago, 11 months ago, like the other one, right? So I got 100 shares by the time they calculated. So I've already earned $24 here. right? Now another 24.29, 24.61. If you add all of these amounts up, look, 49. If you add all these amounts up, 75, I might still be at a loss, but just barely. I'm going to go over in dividends what I lost in equity. And that is why you buy in equity stock. I don't want to bore y'all, but I could do the math if you just want to see real quick. So 92.48. If you just go 92.48 to 90.96, that's $180 right there. That's $180. Let's say because we didn't carry the cents over and the extra $2, this is $270 right here. Right? And this is another 50, so that's 320. Where we at? Where we at? Where we at? This is 75. Okay, you see it was at 52 and it jumped up to 75 and it's going to drop down again. This is what I was telling y'all, right? It was at $50. This is what I stumbled upon. Let me explain this. So, at this point where it in July for August, it paid, okay, so it paid me $50 here in August, right? I bought another 100 shares here in September. And then I only had them for a couple days. So September 11th, I had them for 5 days. On that fifth day, I sold that 100 shares and I actually for 2 cents higher because I actually didn't mean to buy them when I bought them, but I did it. And so I tried to hold on to it until it went back up and I sold it. But it had already calculated that I had this extra 100 shares when it calculated what my dividend was going to be because it calculated it. The cutoff was probably on the 11th, I believe. And then it calculated those extra 100 shares. So it paid me $75 based on what I had on this date, not based off of this date when I had already sold it. So if you want to play a game with it, you can do that. You may lose some equity in it. So you could buy it on, you could buy an extra 500 shares of something, right? And then 2 days later, sell it, right? Hopefully it's REITs, so they don't move up and down that quickly. So you might sell it for the same amount. So then you pay the brokerage fee on the transaction. I think it's like 25 cents per transaction, but they will calculate that extra amount of shares, however many you have. So if that's earned and you bought 500, that'd be what, $8 times 5, $40. That'd be a $40 dividend. And then you already sold the shares, but now it paid you $40. So it's, I mean, you can game the system if you want to, but I did it by mistake. So right here, it jumped up to 75 and I had sold the shares. And so it went back down to what, $50? There it is, $50. All right, I came in late. Can we quickly go over REITs and the other equity stock? I understand the dividend. Cool, 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 cool. All right, so there's two different types of stocks that I talk about here in the Forge. So you have an equity stock and you have a dividend stock. So the difference is this: an equity stock is like Amazon, Microsoft, Nike, um, Tesla, Nvidia. There are companies that you're going to buy today at $80. You would hope. Just this is an example. You're going to buy it today for $80, but in 2 years, it's going to be worth $160, right? The equity. So it'd be worth to you if you had one share $160, but out of your investment, you made 100% investment because you doubled your investment in it, right? So it went from 80 to 160. So you have $80 worth of equity in it, right? So you made 100% return. That's equity stock. Does that make sense? You bought it for the amount, the value it's going to go up over time. And equity stocks is what is going to move the needle mostly in your portfolio, right? So now you have dividend stocks. Dividend stocks are companies that some of those stocks that I named, like Coca Cola, Microsoft, I didn't name these two. I did earlier on, right at the beginning. I even looked at these. They pay a really small dividend. I think Microsoft was 443 bucks a share, and they paid a dividend of like 0.69%, not even 1%, right? And Coca-Cola was like $1,292, and they paid a dividend of like it's in the chat up here somewhere, 0.31%. And that 0.31 from Coke wound up being a $4 a year return. You are breaking the bank. Pepsi was trading at what is Pepsi trading? Let me show you. I try to keep these Saturdays at 12 p.m. Pacific Standard Time, folks, so y'all know when to get in. I try to, today I got on 5 minutes prior, and I put a message in the chat saying 5 minute warning or 5 minutes or something like that. So everybody, you should get alerted. Turn those notifications on. You might be busy. I don't know your life. And that's anybody and everybody. All right. But I'm recording it this time so I can put it on YouTube. And there's the one from last week I recorded too. I just didn't extract it. All right. So Pepsi's trading at 149, and it pays a dividend percent yield of 3.57. And if you look up here in the chat, we calculated that to $5.33 a year from having just one share. But one share is going to cost you $1.49. So the reason I said I suggested REITs is because these are equity companies, equity stock companies that pay a dividend. So you have a regular equity stock that doesn't pay a dividend. Most of them do not, right? They don't give you any kickback because the kickback you're getting for buying the share is the equity. They're already paying you by doing good business. But then the bonus is you can have an equity stock that pays a dividend, but usually the dividend is incremental, right? Because they're putting most of the money back into the company, right? Because they want the equity to continue to grow. So now you have those two. So there's a difference in a regular equity stock with no dividend and an equity stock that pays a dividend. It's usually incremental. However, now you have real estate investment trusts, and they are not equity stocks. They're way over here on the other side of the slider, and they're way less money to purchase because they actually from year to year don't move very much. Let's look at EARN. Watch this. I'll show you. So EARN's trading at 662 today. Obviously, the stock market's closed, but in the past year, it only gained 6%, which for EARN, 7%, which for EARN is only 43 cents. You see that in a year? Now for an equity stock, you are lights out in the red. That is dumb. Nobody's investing in your company. You can't be an equity stock and return people 7%. Okay, on a regular year, yeah, you could. But in the past 2 years, that would have been unacceptable because the stock market moves about 10% a year because it follows the S&P 500, the top 500 companies out there that go up about 10% a year. But in the last 2 years, that hasn't been the case. That has been up like 20%, right? So if you are a regular company returning 7%, especially in these last 2 years, you lost out. You lost some investors. Sorry, Jack. 7% in these last 2 years ain't good enough. But anyway, squirrel. All right, so 662, it only made 7%. So it didn't move much, right? So if you took that same amount of money and invested in this, you could get more shares, which would pay you more dividends because the percent that this yields is 14%. Does that make sense? So it's a volume game. So you can buy with the same amount of money, you could buy one share of Coke, you could buy a heck of a lot more EARN. and you can actually wow, pardon the pun. You could actually earn a lot more money per year in dividends. And remember, it's not after 12 months you earn it, it's every month you're earning it, and incrementally it's creeping up every month to what it yields per year. So you're getting that every single month, every month. So I think we're good unless y'all have any more questions, chat. I'm kind of on y'all's time. This went an hour and 30 right now, but I'll take two, three more questions if you have them. Is everybody a-okay? Does everybody get it? Do we understand why we should invest in dividend stocks? Dividend stocks versus equity stocks? And do we understand the difference between an equity stock without a dividend, an equity stock with a dividend, and a dividend stock in a REIT? All right, I think we're good. Just peachy. All right, folks, thank you for tuning in. I am going to do my best to get these videos up on YouTube this week. And you are most welcome, chat. I know y'all appreciate it, and that's why I do it. I'm just a regular guy that cares. I do this in real life, been doing it in real life for some years in the military, and I want to see people win. And, it's a little story about me if I didn't tell you, but it's actually my wife, the reason I have this podcast, because I kept coming home telling her all of the young men that used to come to me for mentorship and didn't know what their credit score was, what a credit score was, didn't know what a credit report was, didn't know the three bureaus, didn't know how to do a budget, didn't know about investing, nothing, right? And I kept telling her about it, and then she would see them come up to me in public, and 30 minutes later, when she's pulling at my arm to go, they're still trying to get info. When we're at the gym lifting weights, they're trying to figure out, how do you get like this? How do I make this cut? How do I, and they just have questions. And there's so many young guys out there with questions, and they need knowledge, that she said, you really should think about doing a podcast. And that's really where the vision came from. She just saw what I was doing already and said, expand it to social media, because you can reach a larger audience. So y'all can thank her. But yeah, the blacksmith closing up the forge, baby. The forge going cold. I will see y'all next week, 12 o'clock Pacific Standard Time. Be there or be square or broke. No, don't be broke. Don't be broke. Just be there. Just be there. All right, folks. The forge is closing up. I'll see y'all. I do need a hammer. Hey, I need a hammer. First of all, before the forge goes cold, okay, I need a hammer. You see this? You see this? I need a hammer. But this desk is only made of like plywood, so I would probably chop it in half or smash it in half. So yeah, I need a hammer. I need a hammer. T-shirts. This is my last little announcement, I guess. T-shirts. I got some T-shirts in. They're all large size, but these T-shirts I'm wearing are not just for me. I'm gonna have them for sale soon. Hold on, let me show you some. All right, so this is the icon on the channel, right? It just has the Blacksmith Podcast name, and it's got my dude on here forging. He's got about as much hair as I can. If you can see some of his scalp, I won't bother bending my head down, because that's about what you'll see. And then it's the same as this one. It's got the icon. So I have gray, I got this navy blue, I got black and then green. My good old sister-in-law hooked me up with these. Um, so, yep, these T-shirts will be for sale. I'll take pre-orders. Just let me know what size you wear, and we can get these out to you. Anyway, the forge is going cold. I do need a hammer. Listen, folks, I need a hammer. Mjolnir or Mimnir, whatever it is, Thor shouldn't be the only one with a hammer. Forge going cold, folks. See you next week. Jay, you still there? Jay, you still there? Unmute your microphone. I don't know if I'm still going out. Jay, you still there? You're muted, good sir. Oh, you probably can't talk. You at work? All right, I think I might have been muted. All right. Well, I'm gonna close this up and then just hit me up.